All right, guys, we're going to go ahead and get started. This is a webinar for retirement income planning. And there is a chat box that you can use to ask questions. And if we have time at the end, depending upon how long things go, I'll try to answer some of those at the end, if there are any. Honestly, this particular topic or webinar is probably what I think is one of the, if not the most important webinars that we offer here at Wright-Patt. I think everything else topic-wise can pretty much fit in some manner into this topic of retirement income planning. And so I just had a few statistics up here on the screen about retirement and working and financial planning and that type of thing. So hopefully you got to see those. Just want to get through some of the disclosures here. But when it comes to planning for retirement, it basically starts with three basic questions. And everyone has kind of a different idea of what retirement looks like. But really what you need to ask is, what does retirement mean to you? What do you want to do in retirement? What are your expectations in retirement? Do you plan to travel? Do you plan to pursue a hobby, maybe go back to school or start a business? So it's important really to consider those expectations carefully, because your retirement income plan will be designed to support the lifestyle that you envision for yourself. When do you plan to retire is another big question. And as we'll discuss, it can have the age that you retire can have an enormous impact on your overall retirement income situation. And then the third one is how long will your retirement last? So in other words, how long of a distribution period should you plan for? And we're going to spend the next few minutes looking at the last two questions. So, as I mentioned, when you decide to retire can have an enormous impact on your overall retirement income situation. So we're going to talk a little bit about early retirement, and most of us would like the chance to retire early, but early retirement can have significant financial repercussions. First, when you retire early, you're giving up what really could be the prime earning years of your career. These are the years during which you could be making significant additions to your retirement savings. In addition, the earlier you retire, the longer the period of time that your retirement assets need to provide for you and for your support. And then, so what that's doing is increasing the risk that you could potentially outlive your money or outlive your nest egg. You can begin receiving Social Security retirement benefits as early as age 62, but if you elect to start receiving benefits at age 62, your benefit may be as much as 25 to 30% less than if you waited to your full retirement age, which is typically somewhere between 66 and 67, depending upon the year you were born. So we'll discuss Social Security in a little further detail later on. Also, you're not eligible for Medicare until age 65. So unless you're eligible for health benefits through your employer, or have coverage under a spouse's plan, or take another job that offers health benefits, you've got to factor in the cost of paying for insurance or out of pocket cost for health care, at least until you qualify for Medicare at age 65. And then additionally, if you're covered by an employer pension, you want to make sure that it won't negatively, that retiring early won't negatively affect your pension benefits. The greatest accrual of benefits under a pension plan generally occurs during your final years of employment, and it's possible that early retirement could reduce the benefit that you were planning to receive. And so as you may suspect, delaying retirement presents certain advantages when it comes to income planning. Okay, first of all, the longer you work, the longer you'll be able to continue contributing to your retirement savings, and also your retirement saving balances generally are, at the higher points than they've been throughout your life, and so those higher balances can lead to more dollars added to those balances as the investments grow or continue to increase. Okay. Even if you're no longer adding to your retirement savings, delaying retirement basically postpones the date that you'll need to start withdrawing from your savings or your nest egg, and a shorter distribution period could significantly enhance your savings potential to last throughout your lifetime. In addition, delaying retirement may mean that you can delay taking Social Security benefits, which potentially increases your annual benefit when you do start Social Security payouts. And then continued employment may also mean continued access to company-sponsored health insurance. So these are all, potential benefits of delaying retirement. Now, of course, if you plan on working during your retirement, that can also have an impact, and there's benefits for that. The obvious advantage is that working during your retirement, you'll be earning money and relying less on your retirement savings, which leaves more of your savings to potentially grow for the future, helping to stretch that savings over your remaining lifetime. In addition, full or part-time work during retirement could provide access to continued healthcare benefits. If you work during retirement, you'll want to make sure that you understand how the income you earn might affect Social Security benefits. While your earnings may increase your Social Security benefits in future years, current benefits could be reduced if you had started Social Security prior to your full retirement age. So generally speaking, $1 in Social Security benefits is generally withheld for every $2 that you earn over the annual earnings limit. So in 2022, that earnings limit is $19,560. So if you have started Social Security prior to your full retirement age and you make over $19,560, then your Social Security benefit will be reduced, as you earn over that threshold or that limit. Okay. It's also worth noting that there are a number of non-financial benefits to continue working. There's, social interaction, the sense of accomplishment, structure, to a day. I mean, one of the things I learned through the COVID season, as a lot of us were working from home, that's not for everyone. And for me personally, that's not something that I really enjoyed, was working from home. Of course, I've got a lot of kids, and privacy at my house is a premium, but I do a whole lot better when I have structure to my day and can really go into the office, and, I'm more productive that way. But there's benefits to working other than just the financial elements of that. And then one last observation is that if you're working for an employer that offers a traditional pension, you've got to determine whether working part-time will impact your benefits. If your benefit is based upon your final average pay, it's possible that working part-time could actually reduce your benefit because your income is obviously lower. So it'd be worth inquiring about any phased retirement program that your employer might offer. These programs might allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. Okay. How long will retirement last? Okay, well that's a big question when it comes to planning. It's kind of the unknown variable because it's based upon life expectancy. And the good news is that we're living longer lives. The bad news is that generally translates into a longer period of time that you'll need your retirement income to last. And it's interesting. I've seen statistics that show that as much as 75% of people significantly underestimate how long they will live. And so in my world, when you're putting together a financial plan, that's something that we would rather over plan for and not under plan. We don't want to plan on someone passing away at age 80 and they ended up, living to age 85, 90, whatever the case is. So according to the National Center for Health Statistics, the average 65-year-old American can expect to live for another 18 and a half years, so essentially getting you to age 83, 84, 85 on average. Life expectancies have increased at a steady pace over the years. It's expected to continue increasing. And so for many of us, it's not unreasonable to plan for a retirement that lasts for 25 years or more, which means your income and savings will need to last that long as well. Every retirement plan, income plan really has to balance three main goals. One is to maximize your ability to enjoy your retirement. That means making sure that you have the financial ability to do the things that you want to do. Okay. It also needs to minimize the chance or the likelihood that you will outlive your money. And then it also needs to manage the financial risk of unwelcome life events such as serious illness, the need for long-term care, or other, unanticipated expenditures for yourself or your family. But these are all things that, we try to accomplish as part of a retirement income plan. We're going to go into the process of developing a plan. Once you know when your retirement will start and how long it may last, the type of retirement lifestyle you want, it's time to basically estimate how much money you're going to need, to make it all happen. And so the first thing you want to estimate for your future retirement expenses to determine how much income you'll need. Okay. Factoring in the potential cost of healthcare and long-term care. Then you've got to consider major factors that will affect your income. For example, you have to adjust for inflation. And you also need to understand the potential impact of taxes on different types of accounts and investment risk. Then you total all the fixed income sources you expect to receive, which would be, Social Security and pensions. And when you compare your income needs to your fixed income sources, you'll likely find that you won't have enough income to meet your needs and your goals. And this is basically what's called the gap. And closing this difference or closing this gap is basically the important part of a retirement income plan. So to supplement your fixed income sources, you basically have to rely on your retirement savings and leverage that savings to subsidize, the other income, Social Security and pensions. So how you go about doing this, including the products and the strategies that you should consider, really depends upon your current assets, the amount of additional income that you need to generate, and the ability for you and your plan to tolerate risk. And those are two different things. And what I mean by that is your risk temperament might be one thing. You might be a real conservative investor, but your financial plan requires you to potentially take on more risk than you're comfortable with in order for you to meet your goals. So how are you going to compromise, between those two different needs? What you're comfortable with as far as investing, but also what your financial plan requires you, the amount of risk that your financial plan requires you to assume. So we're going to take a look at step one in the process, which is basically estimating how much income you'll need. And when trying to figure out the amount of income you'll need in retirement, you may be tempted to just rely on some very general guidelines. And most of these general guidelines consist of, you may hear that you should plan on needing somewhere between 60% and 90% of your pre-retirement income when you retire. Man, that is a very general rule of thumb. Okay. But using a general guideline like this one, while it's easy, really isn't very helpful because it doesn't take into consideration your unique circumstances, your expectations and goals. To me, using a general guideline like this is probably okay when you're saving and investing in your 20s, 30s, 40s. But you start getting into your 50s and certainly late 50s as you're approaching retirement, you want something that's going to be a little bit more detailed than just a 60 to 90% rule of thumb. So instead of basing an estimate on your annual income needs on a percentage of your income, you want to focus instead on your actual expenses today and think about whether they'll stay the same, whether they'll increase, decrease, or even disappear by the time you retire. Some of those expenses may disappear, like a mortgage or cost of transportation to and from work. But new expenses may come up. It may be expenses like yard care services, snow removal, home maintenance, things that you might currently take care of now by yourself, but may not want to or may not be able to in the future. And what you've got to look at are what I would call are your basic living expenses. And I always kind of describe that with folks as if you do nothing else in retirement other than sit at home all day long, there are certain expenses that you have that will continue on that you can't get away from. It's groceries, utilities, property taxes, insurances, stuff just to keep the household going, right? Those are your most basic living expenses. Any debt that's going to continue to be serviced, that type of stuff. But then you start including cost on top of that for lifestyle expenses. If you want to travel or if you have hobbies that are going to be part of your retirement, you've got to factor these costs into your retirement expenses as well. Now, they're a little bit more discretionary, to where you don't necessarily have to have them. But generally speaking, people want to do extra stuff in retirement that costs money. And so those are all things that you've got to account for. It may be a pain, to try to detail every potential expense that you can think of, but it's really important to get a handle on what that budget is across the board for like I said, for living expenses and lifestyle expenses, and trying to break those up into two different categories. Okay. The more accurate that you can be in those expenses, then the more accurate your retirement income plan will be as well. One major expense to consider is healthcare. Once you retire, you're likely to focus more on healthcare than ever before, and there's a greater chance that your health is going to decline. Most Americans are automatically entitled to Medicare coverage once they turn 65. When you're eligible for Medicare, you've got to make some coverage elections. For example, you have to decide whether you want to purchase Part B, which is coverage for medical care, including physician care, laboratory tests, and physical therapy. You may also want to consider joining a Medicare prescription drug plan, which is Part D, as in David. Or you might want to sign up for a private company or insurer that has been approved by Medicare. Okay. It's also important to understand that Medicare won't cover all of your healthcare expenses. For some types of care, you'll have to satisfy either a deductible and make co-payments, and that's why you might consider purchasing a Medigap policy that offers additional coverage. And it's also important to understand that Medicare won't pay for long-term care if you ever need it. And so because Medicare doesn't cover long-term care, it's important to consider the potential impact of a prolonged stay in a nursing home. So we're gonna talk a bit about what's meant by the phrase long-term care. Long-term care basically refers to the ongoing services and support that one needs by people suffering from chronic health conditions or disability. And that long-term care can either be in-home care or it can be out-of-home care. And there's advantages and disadvantages if you're going to stay in home, just like there's advantages and disadvantages if you go out of the home. It's hard to face the fact that our health might decline, but statistics suggest that most of us will need long-term care during our lifetimes at some point after we reach 65 years of age. Currently, the nationwide average cost of 1 year stay in a semi-private nursing home room is more than $93,000 a year. Okay, in some states it's much higher. In the future, long-term care will likely cost even more. If costs rise at just an average rate of 4% a year, in 20 years, 1 year in a nursing home could cost approximately $204,000. Okay, so healthcare is one of the highest areas of inflation that we face. Okay. So if you needed it, how are you going to pay for this care? You might consider paying out of pocket, which means using your income, your savings, investments, and assets such as your home. But paying out of pocket is also a gamble unless you've really saved well and are pretty wealthy. Okay. Many people will assume that Medicaid will pay for those costs. You may be able to rely on Medicaid, but there's a catch. Sorry, I'm getting a little ahead here. In order to qualify for Medicaid, you got to keep in mind that Medicaid is a low income program, and so your assets and your income must be low enough to allow you to qualify. And so what that means is you'll have to use up most of your savings before you can qualify for Medicaid, aside from maybe a small personal needs allowance. You'll have to use all of your retirement income, including Social Security, pensions, to pay for the care before Medicaid's going to kick in. So, like I said, there's a catch. Another option to consider: long-term care insurance. Insurance, may provide a source of funds to subsidize other sources of income, to subsidize savings in order to take care of some of that long-term care costs. So, this is all part of building a financial plan, a retirement income plan that is sustainable. Okay. Before we go on and talk about retirement income sources, we're going to review some of the factors that make retirement income planning so challenging. First, if you can accurately predict your retirement expenses and can calculate the exact amount of retirement income that you'll need each year, one of the things that you have to adjust your calculations is accounting for inflation. And if you're paying attention to where we are today, I mean, I just saw reports where basically over the past 12 months, inflation is up over 8% for the last 12 months. Okay. That's obviously significantly higher than the historical average of inflation, which typically we estimate at about 3% a year. But you've got to adjust for inflation in your retirement income plan to give you some rising income over the years. You also have to keep in mind and account for the effect of taxes on your withdrawals and distributions. And then finally, your income plan will have to balance your need for ongoing income with the level of risk that you're willing and that you're able to accept. Okay. We're going to talk a little bit about inflation and kind of spend some time on that. And I often refer to inflation as kind of the silent stealer, so to speak. It's the idea that, look, if you had $50 in your wallet and someone comes in and takes it all, that's pretty obvious that, you were robbed, right? But, what if they just come in and take out, $1 or $2 at a time? Would you even notice that? And honestly, that's what inflation does. It just kind of chips away at the purchasing power of your dollars over time. And if you don't account for inflation properly, you'll likely underestimate the amount of annual income that you'll need in retirement. Inflation is basically just a general increase in the cost of goods and services over time. In other words, it's the purchasing power of a dollar will likely decline over time due to that rising cost of goods and services. And so at 3% inflation, a given sum of money will lose half of its purchasing power in a 25-year period. So put another way, at 3% inflation, a gallon of milk that costs $4 today would cost over $8 in 25 years. So keep in mind that inflation doesn't affect all goods and services equally. In fact, retirees can be affected by the disproportionate increase in the cost of some things. I mentioned healthcare cost has historically increased at a rate much higher than the inflation rate of everything else. And so what this chart is basically showing you is that, if you need $50,000 in income today, at 3% inflation, look at how much income you will need just to be able to buy the same stuff, assuming a 3% inflation rate. Okay. So you've got to allow and you've got to plan for rising income throughout your retirement years. The other thing that we had mentioned was to make sure that you account for taxes and the effective taxes on your distributions in retirement or on your pension income and so forth. Keep in mind that some income, like interest, is going to be taxed at ordinary income tax rates. Other income will be taxed at, capital gain, long-term capital gains, maybe qualifying dividends. There are some investments like municipal bonds that generate income that can either be exempt from federal income tax and sometimes state tax as well. Okay. You've also most people have their balances tied up in some type of retirement plan, IRAs and 401ks. So you've got to recognize that distributions from those types of accounts are taxed as income and taxed as ordinary income. And regardless of whether the investments within the account have generated long-term capital gains or qualifying dividends, it's taxed as you take withdrawals. Okay. Now there are special rules that apply for Roth IRAs, Roth 401ks, Roth 403bs, etc. Generally, Roth accounts are not taxed on withdrawals because that money was taxed before it went in. Okay, so you just gotta account for how your investments and different types of accounts and investments are going to be taxed, and take that into consideration. Now, different types of investments will carry different risk. Sound retirement income planning involves understanding what these risks are and how they can influence your available income in retirement. And so some of the risks that really need to be accounted for, everybody assumes, market risk is the only thing that you need to account for. Well, I mean, that's probably the most obvious one. The risk that fluctuations in the market may result in a reduction or depletion of the value of your retirement savings over time. Okay, we're going to talk about that in a little bit further detail coming up. There's also reinvestment risk. So it's the potential that you may have to reinvest at a lower rate of return than the investment that you're coming out of. Okay, so CDs are generally a good example of that. There are a lot of folks that had CDs that maybe were opened up, back in 2006, 2008, 2010, whatever the case is. As those CDs are maturing, the old CDs were paying 4%, 3%, etc. And, now they're paying 1.5%. And so that money's having to be reinvested at much lower interest rates today. Okay. There's interest rate risk, which is really correlated to bond markets. So this is something that could certainly be a concern going forward, because as interest rates go up, generally speaking, the value of bonds will go down. Okay. Now, short-term bonds may react a little bit differently than long-term bonds and so forth, but there can be downward pressure on bonds due to rising interest rates. I think we're certainly seeing some of that right now. Okay, I mean, obviously the stock market's down for the year, but the bond market is also taking a hit. Okay, so I think some of that is with the anticipation of rising interest rates. Couple that aren't listed on here that I'll mention are recessionary risk. Okay. Which is basically, when the stock market has a period of long-term market declines. I'll give an example. From 2007 to 2009, everybody kind of remembers the mortgage crisis, where the stock market was down over a period of 18 months. Well, that fails in comparison to what we saw in 2000, 2001, and 2002, where every single year of those 3 years, the market was negative. Okay, so if we're going through a market decline right now, I would rather it get over with quickly and drop sharply and start a recovery sooner than see it drag out for 2 or 3 years. Okay, but that recessionary risk can really play havoc on one's portfolio, and I'll show you that in a little bit. there's pension risk out there. I come across folks all the time that their pensions are at risk of either being reduced or they're being offered a buyout of some sort because their pensions are not staying solvent. And man, if pension plans are not staying solvent as the market has had all-time highs really over the last, 10 years or more, 12 years or more, my gosh, how are they going to stay solvent? Okay. So there's real risk there in regards to pensions either being, again, bought out or being reduced. After you've estimated the amount of income that you need, which is, of course, certainly correlated to the expenses that you're going to take on, you've got to determine the annual income that you can count on, or what I would call that secure income. Traditionally, retirement income has basically been described as a three-legged stool. It's comprised of Social Security benefits, a typical traditional employer pension plan, and then the third leg is the individual savings, is one's individual savings or nest egg for 401ks, IRAs, things of that nature. The first two legs of the stool really produce kind of a steady or relatively fixed level of income that you can depend on. But a lot of folks don't have pension plans any longer. There's the percentage of population. I mean, I've heard it as low as 8% of the population has pension plans any longer. So, we're going to we're going to show, most people aren't able to rely on Social Security to provide for all of their retirement income needs. You may not have an employer pension as an option to you. And so that means that the third leg, which is the individual savings and investments, is likely going to play a major role in funding your retirement. And so, but to start, we're going to look at the first two legs of that stool, which is Social Security and pensions. 97% of those age 60 to 89 either receive Social Security or will receive it. Okay. Now, the amount of Social Security retirement benefit that you'll receive is based on the number of years that you've been working and the amount that you've earned. Your benefits calculated using a formula that basically takes into account your 35 highest earning years. Okay. So as you're getting later in life and later in your career that you're making, probably the highest level of income that you've ever made, that income that you could potentially be earning in the later part of your career might be replacing some early years of your career where you didn't make much income. Okay. And so they're going to calculate the 35 highest earning years to determine your Social Security benefit. If you, one of the ways that you can find out what your benefit is, typically they're not mailing out the Social Security statements any longer. You can go to ssa.gov and sign up for my Social Security account, and it'll show you and kind of break down for you what your particular benefit will be, at any given age, 62, full retirement age, 70, etc. So if you haven't done that, take the time, go to ssa.gov and sign up for my Social Security account. The earliest, we'd mentioned this before, the earliest that you can begin to receive Social Security benefits is age 62. If you decide to begin receiving benefits before your normal retirement age, which will range from 66 to 67, there's a drawback. Your monthly benefit will be permanently reduced, okay? And in fact, if you begin taking benefits at age 62, each monthly benefit check will be 25 to 30% less than it would have been if you waited to your full retirement age, okay? Now, on the other end of the spectrum, you get a higher monthly payout if you delay your benefits up to age 70. Okay. Now there's no reason at all to postpone them beyond age 70. They're not going to increase beyond that. But so part of retirement income planning is trying to figure out, what is that break even point of taking Social Security benefits at age 62 versus full retirement age, or even age 70. How long do you have to live in order for those payouts to equal? And then, of course, the longer you live, that's where the benefits at age 67 or full retirement age, or your benefits at 70 are going to start paying out better for you. Okay. We've already mentioned that working in retirement can also affect your Social Security benefits. That's certainly something that you want to keep in mind. Also worth noting is that the federal government periodically will adjust Social Security for inflation. But the bottom line is, for most people, Social Security in and of itself is not going to provide enough income in retirement. We're going to talk briefly about employer pension benefits. If you're entitled to receive a traditional pension from an employer, you're lucky, okay? Because like I said, very few Americans at this point are covered by pension plans. If you haven't already selected a payout option, you want to make sure that you understand and carefully choose what your payout options are going to be. Pension plans, generally speaking, are an annuity. They're going to pay out over your lifetime. And many plans will allow you to retire earlier, and your benefit may be reduced, but a pension plan will typically provide a single life payout for the plan holder. There can also be what's called a qualified joint and survivor annuity option, which basically means that income will continue on to a surviving spouse on some level, depending upon what you sign up for. There are other options that you may have, lump sum options. You may have I'd already mentioned kind of the survivorship options, but you want to make sure, does your plan offer inflation adjustments to your pension? Is there a cost of living adjustment, going forward, or is it just flat throughout your lifetime? And, prior to retirement, your pension plan should provide you with what I would call a summary of benefits, or an explanation of benefits that basically tells you the various options. And then, you want to make sure that you understand those and see how those are going to fit into your overall retirement income plan. We talked about identifying the gap. So again, if you compare the annual income that you're going to need in retirement, and that annual income is going to be based upon your expenses, living expenses and lifestyle expenses, you want to kind of compare that to how much secure income you will have in relation to Social Security and pensions. Okay, so you're going to subtract the income that you need. You're going to subtract out the secure income that you will get from Social Security and pensions. And like I said, you're likely to come up with a shortfall, and that's where you'll have to subsidize that income from the third leg of that stool, which is your personal savings and investments. Okay. Now, when we're talking about personal savings, we're talking about funds that you have in tax advantaged accounts like IRAs, 401ks, 457s, 403bs, as well as any investments you hold outside of tax advantaged accounts. Could just be money you have sitting in a CD or savings or money market account. It could be, separate brokerage accounts. But when it comes together to putting a plan together to convert your personal savings into a source of retirement income, there's several things that you have got to consider. First and foremost, the challenge is to implement an investment strategy that provides with reasonable certainty the annual income that you'll need, while also balancing that need for regular income with other considerations like liquidity, your risk temperament, and the anticipated rates of return. So asset allocation is deciding how much you'll put into various types of investments. Asset allocation is going to be an important part of your retirement strategy. Beyond general asset allocation, you really should become familiar with specific investments and products that can play a role in your overall investment strategy. Withdrawal rates. Your withdrawal rate is the portion of your portfolio that you're going to liquidate each year for income. And the question that you'll need to answer is, how much can you withdraw each year without exhausting your savings? We're going to spend some considerable time here in some slides coming up on withdrawal rates, and that is a very important variable or piece to a successful retirement plan. Thought also needs to be given to the order in which you will tap into various accounts. For example, tax considerations can affect which accounts you should choose first and which you should draw from last. Legacy planning goes into that. If your main priority isn't necessarily income, but it's legacy, that could change up the order of accounts that you withdraw from. Okay. You also want to consider upfront, how you'll deal with required withdrawals from tax advantage accounts like IRAs and 401ks. So those withdrawals, those required minimum distributions they're referred to, those start now at age 72. Used to be 70 and a half, but they've now been permanently postponed to age 72. So the first thing we're going to talk about is asset allocation. During your accumulation years, your asset allocation decisions may have been focused primarily on long-term growth. Okay. In retirement, however, you're transitioning from growth and accumulation to income and distributions, and that is really a completely different ballgame. While you were saving, as long as your overall portfolio was earning an acceptable average return, you might have been happy with that. However, now that you're planning to retire and rely on your savings for income, the consistency of year-to-year returns and your portfolio's volatility, may have a much greater level of importance to you. You're going to be much more sensitive to value fluctuations in your portfolio, partly because you no longer have contributions going in there every pay period that might be offsetting some of the losses that you were seeing in the market before. Okay. So just kind of human nature, when you're relying on those sources or those accounts for income, again, you get much more sensitive to those ups and downs of the market that maybe you didn't really pay a whole lot of attention to before. Balancing the need for both immediate income and long-term returns is a significant challenge. If you invest too conservatively, your portfolio may not be able to grow enough to maintain your standard of living. If you invest too aggressively, you could find yourself having to withdraw money or sell securities at an inopportune time, like when the market's down. Okay, we're seeing that right now. This could jeopardize future income, could also undercut your long-term income plan. Okay. An effective retirement asset allocation plan really should, provide ongoing income, that's needed to pay expenses. It should minimize volatility to help provide current income and the ability to provide income in the future. It should maximize the likelihood that your portfolio will last as long as you need it to, throughout your life. And it also has to keep pace with inflation in order to maintain purchasing power over time. Okay. And so the next thing we're going to talk about after the asset allocation is withdrawal rate. And like I said, we're going to spend some time on this. How much are you withdrawing from your accounts every year is a significant part of a successful plan. You want to basically withdraw enough to provide the current income you need, but you don't want to withdraw so much that you run out of money too quickly, leaving nothing for the later years of retirement. And the percentage that you withdraw annually from your savings and investments, that's called your withdrawal rate. So the maximum percentage that you can withdraw each year and still reasonably expect not to deplete your savings is referred to as your sustainable withdrawal rate. So to just kind of illustrate that for you, if someone had a $100,000 account and they were taking out $250 a month or $3,000 a year, that would be a 3% withdrawal rate. If you're needing $4,000 a year off of $100,000, that's a 4% withdrawal rate. So you can't expect a 10% withdrawal rate to last for 20 or 30 years using a conservative portfolio. And so I'm going to show you a chart here that's called the Trinity study. And what this chart basically is showing is that depending upon the portfolio that you have, 100% stocks, 75% stocks, and 25% bonds, all the way down to 100% bonds. If someone is able within their budget to just take out a 3% withdrawal rate a year, you could have any portfolio, even 100% bonds, and even in 100% bonds, there's a 80% likelihood that that money at a 3% withdrawal rate would last for 30 years. Okay. Now, as you can see, a 4% withdrawal rate starts reducing the likelihood that that money is going to last, for 30 years in 100% bonds. You go from an 80% likelihood to a 20% likelihood. So what I've done here is I basically have shown you through the colors, a 3 and 4% withdrawal rate is pretty safe. 5, 6, and 7% withdrawal rate, depending upon the risk of your portfolio or the allocation to stocks, I would say that's kind of caution territory. And then getting up into 8, 9, 10+%, like I wouldn't even go there. I mean, you're putting a lot of strain on the portfolio with those higher withdrawal rates. Okay. Well, again, what you're trying to do is you're trying to balance out, how to maximize income without outliving your assets. Okay. Um, 3 to 4% is a typical withdrawal rate. Now, there are a lot of strategies. There's a lot of models that can help you calculate what a sustainable withdrawal rate would be. Some might suggest a fixed percent each year. Some might promote a rate based upon your investment performance each year. So maybe you're just living off the growth. Well, what do you do in years like we're having now when the market's down? Some recommend a withdrawal rate based upon age. Factors got to consider include the value of your savings, the amount of your income that you anticipate needing, life expectancy, the rate of return that you anticipate from your investments, inflation, taxes. All of these things are variables that really can be disruptive for a successful income plan. To give you some idea, though, of the percentage that we're talking about, like I said, 3 to 4% is kind of the typical rate of that would be a sustainable withdrawal rate. It's also worth noting that your withdrawal rate is really important in the early years of your retirement. I'm going to kind of show you an example of that next. That's because withdrawing too much too early can have a significant impact on how long your savings might last. This is an illustration of Jim, who's age 65. He has $500,000 as his nest egg, and he plans to take out 5% a year for income. Okay. So we're showing two different scenarios here. Scenario A is saying that he basically invested in an index fund tied to the S&P 500, and he started taking those withdrawals in 2000 to 2017. And you can see that the balance of his account at age 83 was just over $20,000. Okay. Scenario B is basically taking the same market performance or investment performance over that same period of time, but what it's doing is it's just flip-flopping the order that those returns came in. And this is just for illustrative purposes, okay? So what it's showing here is on the left, this would have been actually what happened because the stock market was down in 2000. It's showing here it was down 10%. 2001, it was down 13%. 2002, it was down 23%. Okay, so he started his retirement as the market was going down. Scenario B is basically just taking those same returns over that period of time and flip-flopping the order that they came in. So in this example, he's ending his retirement when the market's down. Okay. Now, what's important to realize here is the average rate of return in both of these scenarios, because it's the same investments over the same period of time. The average rate of return is 4.95% in both scenarios. The only difference is the order that those returns came in, right? Scenario A is showing those withdrawals starting in a declining market. Scenario B is showing those withdrawals starting in a market that's going up and ending in a market that's going down. Look at the impact that has on the balance of his account. Okay. And this order of returns or sequence of returns could really cause someone's financial plan to really blow up. And quite honestly, we could be in a scenario closer to scenario A right now than we could be in scenario B. And so for those folks that are looking to retire, this year, next year, the year after, this really should give some reason for concern about, what is the market doing in the early years of my retirement as I'm taking withdrawals, because you're having to liquidate more of your investments to get the same level of income. Now, the other thing that's a detriment to this, there's no inflation adjustment on either of these scenarios. $25,000 a year at the age of 65 is not the same $25,000 a year at the age of 83. So, both of these numbers are inflated, are higher than they would probably be normally when you allow for some rising income over the years. But again, the main point of this illustration is just how starting retirement in a negative market in the early years can really be detrimental on the back end of your life. Okay. So, a well thought out asset allocation plan is really essential before you retire and after. Um, Consideration has to be given to the specific investments that you're going to choose. You've got to look into the different investment options. There are different programs out there that can be utilized. Um, Bonds to some extent can help you address some of those investment goals in many ways. Buying individual bonds at their face value, holding them to maturity, can provide a predictable income stream. Bond funds, might come into play, or exchange traded funds. There's other investments that you can use, dividend paying stocks or mutual or exchange traded funds that invest in them. However, dividends may not provide as predictable a source of income as bonds, because those dividend paying stocks, they can cut the dividend, pretty much anytime they want. Okay. Some alternate options to consider. Well, we know CD rates are really low right now. If CD rates are paying 1% or maybe 1.5%, and inflation is 3%, right now we're seeing inflation at 8%, you're safely losing money every year. Okay. There are Treasury inflation protected securities, TIPS they're called. You can also maybe invest in some I bonds. There's quite honestly, with I bonds, I know that's kind of a hot button right now. There's two types of rates that are impacted with I bonds. You have a fixed rate, which quite honestly is not paying anything right now. The variable rate is paying, somewhere probably around 9% or so, but that rate can change easily, and you've got to hold those I bonds for 5 years to avoid any penalty. Which means, if inflation starts to go back down, obviously the rates on those are going to go down as well. So, that might be a short-term solution. Distribution mutual funds that are designed to provide an income stream from year to year, that can be an option, but there's no guarantee that the income will last, as long as the fund predicted. Annuities could be an option. In the example that I showed you before, I mean, quite honestly, let me go back to that scenario with Jim here. I mean, in scenario A, he probably should have looked into an annuity. In scenario B, he didn't really need an annuity. Okay. But the problem is hindsight's 2020, and Jim doesn't know what he needs at the age of 65. Right. So, but annuities could be an option to give some secure income. We're going to spend a little bit of time on annuities. There is a whole workshop or webinar that I teach called The Lowdown on Annuities. The next one that I'm teaching is actually next month on June 8th at noon. An annuity is basically a contract between you and an insurance company. In general, you pay money into the annuity through deposits, and the insurance company is going to pay you income over a period of time. Now, this is really simplifying that, because I've got clients that use annuities that are not really designed around income. They're designed around growth, or they're designed around managing risk. Okay. So this is a very big generalizations of annuities overall. But annuities, do have an element of secure income that you can utilize. They can provide, guaranteed lifetime income. If you annuitize an annuity, you're basically giving up control over your asset. I don't really like the idea of annuitizing annuities. Again, this is stuff that I cover a whole lot more in my annuities workshop. Relative return on the investment. Well, it depends what type of annuity that you're investing in. There's fixed annuities. There's variable annuities, which are tied to the market. There's index annuities, which are kind of a hybrid of fixed annuities and variable annuities. But the bottom line is that, annuities can be a full solution or a partial solution when it comes to retirement income planning. That one good thing about annuities is they're very predictable. You can predict how much income they're going to provide, 5 years, 10 years, 20 years down the road. Okay, so that's one nice thing. And then you're transferring that income risk over to the insurance company as well. So they have their advantages. They have, they can certainly have their disadvantages as well. We talked a little bit about order of withdrawals. Types of accounts. Is the account tax deferred? Is it exempt from taxes, or are you going to take from taxable accounts? I told you, if providing income is the goal, I would generally say that taking from Roth IRAs is the last place that you want to take from. That's the only place you're getting tax-free growth. But each situation is different. So what order you take from your accounts, is really unique to what your plan requires. Okay. If you're more legacy focused, you're probably going to take from taxable accounts, investment accounts last, because your beneficiaries get a step up in cost basis on that investment where they inherit it. And therefore it essentially negates capital gains tax that they would pay. We talked already about required minimum distributions. Those start at 72. One thing to keep in mind, there is a 50% penalty for whatever you don't take out that you should take out as required minimum distributions. Other potential income sources could be your home. They could be cash, existing cash values from life insurance policies. I mean, quite honestly, using these two sources as income, you've got to proceed with caution and make sure you significantly consider, the pros and cons of doing that. Okay. We're just going to kind of recap some things here, and then I'm going to show a brief commercial. When do you plan to retire? How long a period should you plan for? How much income do you need? How much annual income can you expect from Social Security and pensions? These are all things that you've got to ask yourself when you're trying to build a successful income plan. And then, of course, when it comes to personal savings, what's your asset allocation? What's your risk temperament? How much risk does your financial plan require? What investments should you consider? Withdrawal rates, order of withdrawals. All of those are important things to consider. There's a lot of variables, and making that transition from going from a work environment to retiring and going to an income and distribution environment, man, that is one of the biggest transitions you'll go in your lifetime. And it's not something to be taken lightly, to be honest. So only 11% of pre-retirees have a formal financial plan. Okay. So what I'm going to introduce to you here is some of the tools that we use with Money Guide Pro. This is just going to give, it's about a 3-minute video that'll just give you a little bit of information or some insight as to the capabilities that we have here as financial advisors. So I'm going to let this play. We'll come back and see if there's any questions that need answered. And then if you click out, go ahead and there is a survey. It's only like 3 or 4 questions. If you would just maybe take a minute or two to complete that survey, I'd appreciate it.
Life isn't static. Life changes, and it's important to be prepared for those changes. Welcome to Money Guide Pro, the groundbreaking financial planning software that sparks the important planning conversations and helps you create your own personalized plan for your life in retirement. The experience is simple. We start with the easy stuff, your personal information, then move to the exploration of your personalized goals, which are the heart of a quality financial plan. Your goals are divided into needs, wants, and wishes. Not all goals are equal. This will help us prioritize what is most important to you. Buying new cars, paying for college, providing care for a loved one. We'll address each of these and learn what is important to you and why. We also address those items you may not be thinking of. So it's important to include healthcare costs into your goals and discuss longevity to make sure you're protected. Next, we evaluate the resources you have available to fund your goals. We review everything from retirement income, pension and Social Security, to investment assets and insurance, or other assets such as a home, rental property, or business and stock options. Do you have liabilities? We can enter those too, and then view your net worth statement. We'll discuss risk and decide how much risk you're willing to take. You have one question: can I fund all my goals without running out of money? We provide an easy to understand result called the confidence meter, which shows you your probability of success. If you want to see more detail within the result, you can drill down into each individual trial or view a year-by-year breakdown. The plan may not end up in the confidence zone initially, so we'll make recommendations to get your plan into the confidence zone. One of the most interactive tools, the Play Zone, allows you to instantly see how changing some of your expectations, when to retire and how much to save, can impact your plan. We can also test the effects of risks outside of your control. Most importantly, your financial plan isn't static. It will adjust with you over time, and we will continue to review and make improvements as your life changes. You'll be able to view your plan through easy online access and see your dreams come into reality.
All right, guys, we're going to wrap up here. It looks like there is one question that I'll address in regards to long-term care. Do you recommend long-term care insurance for someone who has no dependents? Quite honestly, I think that depends upon the quality of the care that you want. Typically, if you're just counting on Medicaid and are in a facility that that's taking Medicaid, Medicaid's not going to give you, they're not going to pay for all the bells and whistles. They're not, the level of care or the quality of care. I would probably question a bit, if it was totally being paid for by Medicaid. I think it just ultimately depends upon the quality of the care that you're looking for. Theoretically, no, you probably, you may not need long-term care insurance. I think long-term care insurance is really more of a legacy planning tool. You're trying to subsidize the cost of long-term care through insurance so that you could essentially protect and preserve the other assets of the estate to pass on to, beneficiaries and loved ones. So again, that's a very general answer. And that's something, one thing I've learned when it comes to financial planning and income planning, you cannot paint a wide brush across the board, because everybody that walks into my office has different needs and expectations and risk and that type of thing. But that's my 2 cents for what it's worth. You have my contact information there. If you have questions, want to email me, if you need a follow-up call, let me know. We can talk about other things offline, but that concludes our workshop, our webinar for this evening. Thanks for joining us, guys. Have a good night.